Hello friends, welcome to the March edition of Monthly Viewpoints. 2023 has seen an eventful start to markets. Just 2 months ago in December, we were expecting a deep recession in Europe, a mild recession in the US, and there was uncertainty about the COVID-related lockdowns in China. And then over the last 2 months, we have seen that there is no longer an energy crisis in Europe and growth estimates for Europe are being upgraded. In the US too, economic data points are coming out quite strong. Job growth, wage growth, consumer sentiment, and retail sales data has come in above expectations. And in China, we are seeing that the recovery is faster than expected. As a consequence of these stronger economic data points, inflation is also higher than expected. In fact, in Jan, both headline and core inflation in the US came in above expectations. Because of this, expectations of Fed rate hikes have now increased. Earlier, we were expecting the peak Fed policy rate at 5%, which then increased to 5.2%, and currently the market is pricing in 5.4% for the peak Fed rate. At the same time, there are some extreme views looking at even 5.5% and 6% for the peak Fed funds rate. Now, given that interest rates are rising globally, the RBI cannot afford to be left behind. And there is a risk of a tighter monetary policy in India too. Currently, the RBI policy rate is at 6.5%. We have penciled in one more 25 basis point rate hike, but the markets are already pricing in a 7% peak RBI policy rate. Given this environment of increasing rates, growth stocks may come under pressure in the near term and may face some challenges, whereas quality stocks with good earnings visibility and reasonable valuations may fare better. Now, even though there has been a lot of macro uncertainty globally, we have seen a rally in global markets, whereas the Nifty has corrected. Hence, India's valuation, which was at a large premium to other emerging markets, has now declined and it's coming closer to the long-term average. The Nifty's one-year forward PE multiple currently is at 17.8 times, which is just below its long-term average of 18 times. Hence, from a valuation point of view, India has become a little bit more reasonable, and we have seen that the FII outflows have moderated in February. On the growth front, India remains in a relatively better position compared to other large economies, and we believe that not just for FY24, but for the next 3 to 5 years, India will be the fastest growing large economy. The themes we are focused on are domestic focused sectors such as banking and financial services, discretionary consumption, and domestic manufacturing, whereas global focused sectors may face further challenges. Given the uncertainty in markets, we continue to recommend that investors maintain their median level of allocation to equities, and in case there is any correction, they can then look at adding to their equity exposure. We provide a basket of funds for investors to choose from. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।